Central banks love to cut rates in gradual 25 basis point chunks. Nobody really knows why, and analysts say it doesn't always make a lot of sense. Our next report focuses on this. Take a look.
Life is full of unwritten rules. Given Britain's semi-invented central banking, it's no surprise that the world of monetary policy also has its fair share of these silent understandings. The biggest of all, the idea that interest rate cuts happen in gradual quarter-point increments. But analysts say it's a rule that is no longer fit for this day and age. In an era where mortgages are very rarely on floating rates and corporate hedging is more commonplace, cutting rates in bite-sized chunks won't always do very much, not very quickly anyway. Take the 2022 interest rate hiking cycle as an example. It was the most aggressive we've seen for decades, yet the average rate on outstanding US mortgage debt increased by a mere 0.7 percentage points from its pandemic low. That's despite rates on new 30-year lending soaring from 3% to a peak of almost 8%. Analysts say monetary policy has become more like controlling an oil tanker, and it means central banks run a much greater risk of ending up behind the curve if officials decide rates need to go to neutral. One can make a decent case for getting there ASAP. None of this is new, but it's key to understanding how central banks are likely to react through the second half of the year. Last week's inflation surge will support the Bank of England hawks' views of no immediate rate cuts, but the jobless data supports the doves for more immediate rate cuts. The result may be another very gradual 0.25% of rate cut, something we have seen come through since last summer. Analysts say that looks like an awkward compromise. For now, fears about the BOE slipping behind the curve have been allayed by big upward revisions to May's significant drop in payroll numbers. But with employment having fallen in 7 out of the past 8 months, the bank can't take anything for granted. An August rate cut is all but guaranteed. When it comes to the Fed, life is complicated by the very real risk that this summer's inflation figures come in hot. The Fed wants to be quite sure that a one-off tariff increase doesn't morph into a more permanent bout of inflation, and that's still probably true despite another remarkably benign core consumer inflation figure last week. So when the Fed is quite sure that the eye of the storm has passed, it could end up cutting rates fairly swiftly. The ECB is much closer to the end of its easing cycle than the beginning. Unlike the Fed or BOE, ECB rates are already at neutral, neither stimulatory nor restrictive for economic activity. In the week ahead, it is a very quiet time for scheduled US data and events. The proximity to the 30th July Fed meeting means that the central bank has entered its quiet period. So officials are not allowed to comment publicly on the economy and potential monetary policy options. Broadly, the US central bank is expected to stay on the sidelines at that meeting. Business Bureau, WION World is one.